In 2007, I could get almost anyone a home loan. And I don't mean people with good jobs and a couple of dings on their credit. I mean almost anyone. No proof of income, no proof of savings. In some cases, an income number that I helped the borrower land on. We had a polite name for it in the business, a stated income loan. And for about a year, the money was better than anything I'd ever seen. About a year after that, those same loans burned down the entire global financial system. I had a front row seat to why, from inside the building, and it taught me the single most important thing I know about safe money. The rules that are supposed to protect you are not laws, they're suggestions, and they get waived by exactly the people who profit from waiving them, right up until the moment the whole thing collapses on the people who trusted the rules were real. Let me show you what the rules actually looked like from my chair. You'd think a home loan has strict standards. Prove your income, prove your down payment, prove you can pay it back. That's the story everyone believes. In 2007, here's how it really worked. A stated income loan meant you told me what you made, and nobody checked. You could write down a number. If the number was big enough to make the payment work on paper, we could often get it approved. People in the industry had a nickname for the worst of them, liar loans, and everybody knew, and the belt kept running anyway. Think about how insane that is for a second. The one question that actually matters, can this person pay this back, was the one question the system had quietly agreed to stop asking. And it didn't stop asking by accident. It stopped asking on purpose, because asking slowed the belt down. And the belt was where the money was. Why would anyone build a machine that stops checking whether loans are good? Go back to what we covered a couple episodes ago, the conveyor belt. The bank that made your loan didn't keep your loan. It sold it within about 30 days, bundled into a security, shipped off to strangers. Now follow the incentive, because this is the whole disease. If I make a loan and sell it next month, do I care whether it gets paid back in year 3? Not even a little. I already got paid. The risk is somebody else's problem now. Everyone in the chain was in the same boat: the broker, the bank, the bundlers on Wall Street. Every single one of them got paid to say yes and pass the loan down the line before it could blow up. Nobody in the chain ate their own cooking. Picture a restaurant where the cook gets paid for every plate he sends out, never has to clean the kitchen, and never ever eats there himself. How careful do you think that kitchen is? That was the mortgage system in 2007. Everyone was cooking as fast as they could because the diners were somewhere down the line. And the diners were you. And to make it worse, the people whose job was to grade this food, the rating agencies, stamped these bundles of liar loans as the safest possible investment. Triple A, the same grade as a US Treasury bond. Garbage, wrapped in a bow, labeled prime, and sold into the retirement funds of people exactly like you. I'm going to show you who paid when it all came due, and it's going to make you angry, because it wasn't the people who built it. On my site, I keep a plain English breakdown of where the real risk still sits in this system today, the stuff that's dressed up as safe right now. I'll give you the address shortly. First, watch the thing collapse. Here's what happens when a system stops asking whether loans are good. The loans go bad, all at once. Millions of people couldn't make payments they were never really qualified for, and the bundles those loans were stuffed into, the AAA garbage sitting in banks and pension funds all over the world, turned out to be worth a fraction of what everyone paid. And because nobody knew which bundles were poisoned, the whole system froze. Banks stopped trusting each other. Lending stopped. And remember from the last episode what happens when lending stops. Money stops being created. Money gets destroyed faster than it's made. The pool drains. That's 2008. Trillions in home equity, gone. Retirement accounts cut in half. 9 million jobs, gone. Now here's the part that should stay with you. Who paid? Not the people who built the machine and waived every rule. When their bets blew up, Congress authorized $700 billion to bail the banks out, and the Fed created trillions of new dollars to refill the pool they'd drained. The architects kept their bonuses. The system that broke the rules got rescued by breaking one more. The rule that says you can't just print your way out. And you paid twice. Once when your home and your savings cratered, and again, quietly, for years afterward, as every one of those printed trillions diluted the dollars you had left. You followed the rules your whole life. The people who didn't got a bailout, and you got the bill. So here's what 2008 burned into me, and it goes way beyond mortgages. Every rule in this system that's supposed to protect you can be suspended by someone who benefits from suspending it. And the bigger the emergency, the faster it happens. The underwriting standards? Waived for volume. The capital the banks were supposed to hold? Waived when it got inconvenient. The rule against just printing trillions? Waived in a weekend. Even the value of your dollar, the most basic promise, that your money will hold its worth, gets waived every time they decide the system needs saving more than your savings need protecting. There is always an underwriter to call. There is always an exception to be granted. That's the thing I did for a living. I was the guy who got the rule waived. And in 2008, I watched the entire country find out that at the very top, everything is negotiable, and the rules are for you, not for them. Which is the exact reason, years later, one thing stopped me in my tracks. I found a system with a rule that cannot be waived. By anyone. Ever. Not for volume, not for a friend, not in a crisis, not to save a bank, not to save the government itself. Bitcoin. 21 million. There is no underwriter to call. There is no committee that can vote to make an exception because the emergency is really bad this time. There is no phone number for the guy who bends the rule because the rule isn't enforced by a guy. It's enforced by hundreds of thousands of machines that would all have to agree to rob themselves, and they won't. For 17 years, my entire value was that I could get you the exception. Bitcoin is the first thing I ever touched where there is no exception to get. And after 2008, that is the most beautiful sentence in finance to me. Nobody can waive the rule. Think about what that's worth to a saver specifically. Every crisis in this system ends the same way. The rules that protect you get suspended, and new money gets printed, and you get diluted to save the people who caused it. Bitcoin is the one asset sitting completely outside that pattern. When the next emergency comes, and they reach for the printer again, and they will, the supply of Bitcoin does not move. Not by one coin. It cannot be part of the bailout, because there's no one who can expand it to fund the bailout. That breakdown of where the risk really sits today, the assets being called safe right now that rhyme with the AAA garbage of 2007, it's at timtalksfinance.com/members. In plain English, no jargon. It's part of the membership. I built it because I already watched a generation trust the word safe and get wiped out by it. And I'd like you to be the one holding the thing that doesn't need anyone's promise to hold its value. I'm not telling you the system collapses next Tuesday. It might limp along for a decade. Nobody knows the timing, and anybody who tells you they do is selling something. What I'm telling you is the pattern, and the pattern is not in dispute. When it breaks, the rules bend toward the people who broke it, and the bill lands on the saver. You get to decide how much of your life savings you want sitting inside a system where every protective rule is negotiable, versus how much you want in the one asset whose rule can't be touched. That's a probability to weigh. I'm just making sure you weigh it with the lights on. So, those loans I could get anyone approved for in 2007. The reason they burned down the world is that the rules had quietly become optional, and optional rules always get bent by whoever's holding the pen. A year of easy money, then a decade of everyone else paying for it. That's not a bug in the machine. After 17 years inside it, I'm telling you it's the operating manual. And the only place I've found where the rule genuinely cannot be bent, not for me, not for a bank, not for a president with the whole system on fire, is the one with 21 million and no one to call. In a world where everything is negotiable at the top, Bitcoin is the one thing that isn't. That's why I hold it. The breakdown's at timtalksfinance.com/members. Next episode, we leave the wreckage behind, and I show you the good side of this machine. how a single house sale lights up hundreds of jobs, and then how they took that beautiful engine and used it to flood you. I'm Tim. I'll see you there.